Hi guys, most welcome to another informative video. Stocks, bonds, and mutual funds are the words that listen many times. And there are many people who breathe in them in the same way, but you will be surprised to know that there are much different investments from each other. So in this video, we will talk about the main differences between these three investments and how each investment works, and you will also learn what terms and characteristics are unique to them. But give us a minute of your valuable time to subscribe to our channel and hit the bell icon to see more interesting videos like this. So let's get started. Dear friends, stocks, bonds, and mutual funds are well-known and powerful ways of investing. To get desired returns to accomplish the basic goals, it is more important to know that there are different types of investments in a portfolio. So let's start with the basic definitions of this investment. So first of all, we will talk about the stock. So guys, a stock is an own investment. Basically, when an investor buys a stock, that means he takes part ownership in the form of a share bought. The rule is that if the business or enterprise happens to do well, it gives benefits to the investor who invests his money in that business or internship. Well, the investor can also hold or sell his shares at a profit on the stock exchange. If that business does poorly, then simply the value of the share declines and the investor will lose some or all of his investment. That's why stocks are usually risky and only a knowledgeable or experienced person can get profit from it. So we can say that there is no guarantee that the stock will always do well. Moreover, there is potential to earn profitable returns when it comes to stock trading. Companies sell their stock for some reasons, like developing new products, maybe expanding into new markets, or even paying off debt. Now, it's turn to bond. So guys, you must think about what a bond is. A bond is a loan investment, which means that an investor is actually loaning money to an entity like a government, municipality, or company. So we can say that bonds are a type of investment which is designed to aid governments and corporations in raising money. That's why we call this investment as a type of loan. Now, the question is, how does it work? So, guys, the investors who purchase bonds do receive payment in the form of profit. For example, a company needs to raise $1 million for a certain project. Then the company decides to offer a one-year bond to investors to raise the money. Now, the investor will purchase the bond at the issue price, and the company pays the investor profit on the money paid for the bond. When the bond matures, the company will pay for it. Well, bonds are fixed income assets, unlike stocks and mutual funds. But keep in mind that the percentage of profit is fixed in advance. And this way, bonds are rated by credit rating agencies. But there are two types of bonds: government bonds and corporate bonds. When the government needs money, they issue bonds, while businesses issue bonds for loans or overdrafts from the bank as profit rates. Finally, what are mutual funds? So guys, now you may know that stocks and bonds are characterized by asset classes. But what if we talk about mutual funds? Then they are pooled investment vehicles. Now you must be thinking about how it works. Well, money is collected from various investors to buy a large variety of securities in the mutual fund. Well, it gives an investor instant diversification. Mutual funds are much different from bonds and stocks. When the investor invests in a mutual fund, then he does not own shares of the stock. Instead, he owns a piece of the fund. One more thing about mutual funds is that the mutual funds are usually managed by fund managers in financial corporations. Once you purchase a fund, you will never have any control over what goes in or out of the fund, unlike stocks. So we can say that there is no investment in a particular stock or bond, but a combination of various assets. And there is also a commission to be paid. So guys, that's true. Investors do not decide between stocks and bonds, but can decide on the proportion of the two in their portfolio, because stocks and bonds have their own pros and cons. Well, an investor always decides on the proportion according to his goals and the capacity of risk tolerance. Once the investor devises which vehicle might be used to implement asset allocation choices, the investment vehicle can be mutual funds, exchange-traded funds, bonds, or stocks. All these investments are usually based on 4 basic criteria, namely age, income generation, time duration until the money is required, and risk tolerance. Hope so. The difference among them will help to decide whether to invest your money and get a better return on your investment. Keep in mind, not all investments are the same, so keep all the above-mentioned factors in mind before investing. Hopefully, this video helps you a lot. For this super duper video, give a thumbs up, do subscribe to our channel, and don't forget to hit the bell icon to stay tuned with upcoming informative videos. Well, we will come up with another interesting topic soon. Stay blessed.